Open a ZERODHA account. Chapter 12. The Long and Short Strangle. 12.1 Background. If you have understood the straddle, then understanding the strangle is quite straightforward. For all practical purposes, the thought process behind the straddle and strangle is quite similar. Strangle is an improvisation over the straddle, mainly to reduce the cost of implementation. Let me explain this further. Consider this Nifty is trading at 5,921, which would make 5,900 the ATM strike. If you were to set up the long straddle here, you would be required to buy the 5,900 CE and 5,900 pay. The premiums for both these options are 66 and 57 respectively. Net cash outlay equals 66 plus 57 equals 123. Upper break-even equals 5,921 plus 123 equals 6,044. Lower break-even equals 5,921,123 equals 5,798. Therefore, to set up a straddle, you spend 123 and the break-even on either side is 2.07% away. As you know, the straddle is delta neutral, meaning the strategy is insulated to the directional movement of the market. The idea here is that you know that the market will move to a large extent, but the direction is unknown. Consider this, from your research you know that the market will move direction unknown, hence you have set up the straddle. However, the straddle requires you to make an upfront payment of 123. How would it be if you were to set up a market-neutral strategy, similar to the straddle, but at a much lower cost? Well, the strangle is just that. 12.2 Strategy Notes. The strangle is an improvisation over the straddle. The improvisation mainly helps in terms of reduction of the strategy cost. However, as a trade-off, the points required to break even increases. In a straddle, you are required to buy call and put options of the ATM strike. However, the strangle requires you to buy OTM call and put options. Remember, when compared to the ATM strike, the OTM will always trade cheap. Therefore, this implies setting up a strangle is cheaper than setting up a straddle. Let's take an example to explain this better. Nifty is trading at 7,921. To set up a strangle, we need to buy OTM call and put options. Denote: both the options should belong to the same expiry and same underlying. Also, the execution should happen in the same ratio. Missed this point while discussing straddle. Same ratio here means one should buy the same number of call option as that of put option. For instance, it can be 1-to-1 ratio, meaning one lot of call, one lot of put option. Or it can be 5-to-5, meaning buy 5 lots of call and 5 lots of put option. Something like 2-to-3 is not considered strangle or straddle, as in this case you would be buying 2 lots of call options and 3 lots of put options. Going back to the example, considering Nifty is at 5,921. We need to buy OTM call and put options. I'd prefer to buy strikes, which are 200 points either way. Note: there is no particular reason for choosing strikes 200 points away. So this would mean I would buy 7,700 put option and 8,100 call option. These options are trading at 28 and 32 respectively. The combined premium paid to execute the strangle is 60. Let's figure out how the strategies behave under various scenarios. I'll keep this discussion brief as I do believe you are now comfortable accessing the P&L across various market scenarios. Scenario 1: market expires at 7,500, much below the pay strike. At 7,500, the premium paid for the call option, i.e. 32, will go worthless. However, the put option will have an intrinsic value of 200 points. The premium paid for the put option is 28. Hence, the total profit from the put option will be 200 to 28 equals plus 172. We can further deduct for the premium paid for call option, i.e. 32, from the profits of put option and arrive at the overall profitability, i.e. 172 to 32 equals plus 140. Scenario 2: market expires at 7,640, lower break-even. At 7,640, The 7,700 put option will have an intrinsic value of 60. The put option's intrinsic value offsets the combined premium paid towards both the call and put option, i.e., 32 plus 28 equals 60. Hence it's 7,640. The strangle neither makes money nor loses money. Scenario 3 market expires at 7,700 at pay strike. At 7,700, both the call and put options would expire worthless. Hence we would lose the entire premium paid, i.e., 32 plus 28 equals 60. Denote: this also happens to be the maximum loss the strategy would suffer. Scenario 4 market expires at 7,900, 8,100 ATM and CE strike respectively. Both the options expire worthless at 7,900 and 8,100. Hence we would lose the entire premium paid, i.e., 60. Scenarios 5 market expires at 8,160 upper break-even. At 8,160, the 8,100 call option has an intrinsic value of 60. The gains in the call option would offset the loss incurred against the premium paid towards the call and put options. Scenarios 6 market expires at 8,300, much higher than the CE strike. Clearly at 8,300. The 8,100 call option would have an intrinsic value of 200 points. Therefore, the option would make 200 points. After adjusting for the combined premium paid of 60 points, we would be left with 140 points profit. Notice the symmetry of payoff above the upper and below the lower break-even points. Here is a table which contains various other market expiry scenarios and the eventual payoff at these expiry levels. We can plot the strategy payoff to visualize the payoff diagram of the strangle. We can generalize a few things about the strangle. The maximum loss is restricted to the net premium paid. The loss would be maximum between the two strike prices. Upper break-even point equals CE strike plus net premium paid. Lower break-even point equals pay strike net premium paid. Profit potentially is unlimited. So as long as the market moves, irrespective of the direction, the profits are expected to follow. 12.3 Delta and Vega. Both straddles and strangles are similar strategies. Therefore, the Greeks have a similar effect on strangle and straddles. Since we are dealing with OTM options, remember we chose strikes that are equidistant from ATM. The delta of both CE and pay would be around 0.3 or lesser. We could add the deltas of each option and get a sense of how the overall position deltas behave. 7,700 pay delta at 0.3. 8,100 CE delta at plus 0.3. Combined delta would be minus 0.3 plus 0.3 equals 0. Of course, I've just assumed 0.3 for both the options for convenience. However, both the deltas could be slightly different. Hence we could not be delta neutral in a strict sense. But then the deltas will certainly not be too high such that it renders a directional bias on the strategy. Anyway, the combined delta indicates that the strategy is directional neutral. The volatility has similar effect on both straddles and strangles. I'd suggest you refer Chapter 10, Section 10.3 to get a sense of how the volatility impacts the strangles. To summarize the effect of Greeks on strangles, the volatility should be relatively low at the time of strategy execution. The volatility should increase during the holding period of the strategy. The market should make a large move. The direction of the move does not matter. The expected large move is time-bound. Should happen quickly, well within the expiry. Long strangle is to be set up around major events. And the outcome of these events have to be drastically different from the general market expectation. I suppose you understand why long strangles have to be set up around major market events. We have discussed this point earlier as well. If you are confused, I'd request you to read Chapter 10. 12.4 Short Strangle. The execution of a short strangle is the exact opposite of the long strangle. one needs to sell OTM call and put options which are equidistant from the ATM strike. In fact, you would short the Strangle for the exact opposite reasons as to why you go long Strangle. I will skip discussing the different expiry scenarios as I assume you are fairly comfortable with establishing the payoff by now. I've used the same strikes, the one used in long Strangle example, for the short Strangle example. Instead of buying these options, you would sell these OTM options to set up a short Strangle. Here is the payoff table of the short Strangle. As you can notice, the strategy results in a loss as and when the market moves in any particular direction. However, the strategy remains profitable between the lower and upper break-even points. Recall, upper break-even point is at 8,160. Lower break-even point is at 7,640. Max profit is net premium received, which is 60 points. In other words, you get to take home 60 points as long as the market stays within 7,640 and 8,160. In my opinion, this is a fantastic proposition. More often than not, market stays within certain trading ranges and therefore the market presents such beautiful trading opportunities. So here is something for you to think about. Identify stocks which are in a trading range. Typically, stocks in a trading range form double, triple tops and bottom. Set up the Strangle by writing strikes which are outside the upper and lower range. When you write strangles in this backdrop, make sure you watch closely for breakouts or breakdowns. I remember setting up this trade over and over again in Reliance couple of years ago. Reliance was stuck between 850 and 1000 for the longest time. Anyway, here is the payoff graph of the short Strangle. As you can notice, the payoff of the short Strangle looks exactly opposite of the long Strangle. The profits are restricted to the extent of the net premium received. The profits are maximum as long as the stock stays within the two strike prices. The losses are potentially unlimited. The break-even point calculation is the same as the break-even points of a long Strangle, which we have discussed earlier. You can download the long and short Strangle Excel here. Key takeaways from this chapter. The Strangle is an improvisation over the straddle. The improvisation helps in the strategy cost reduction. Strangles are delta neutral and is insulated against any directional risk. To set up a long Strangle, one needs to buy OTM call and put option. The maximum loss in a long Strangle is restricted to the extent of the premium received. The profit potential is virtually unlimited in the long Strangle. The short Strangle is the exact opposite of the long Strangle. You are required to sell the OTM call and put option in a short Strangle. The Greeks have the same effect on strangles and straddles. Open a ZERODHA account. Chapter 13. Max Pain and PCR Ratio. Hindi. 13.1 My experience with option pain theory. In the never-ending list of controversial market theories, the theory of option pain certainly finds a spot. Option pain, or sometimes referred to as max pain, has a significant fan following and probably an equal number of people who despise it. I'll be honest, I've been in both camps. In the initial days of following option pain, I was never able to make money consistently. However, over time I found methods to improvise on this theory to suit my own risk appetite, and that yielded a decent result. Later in the chapter 1 we'll discuss this as well. Anyway, now this is my attempt to present you the option pain theory and talk to you about what I like and what I don't about max pain. You can take cues from this chapter and decide for yourself which camp you want to be in. Option pain theory requires you to be familiar with the concept of open interest. So, let's get started. 13.2 Max Pain Theory. The origins of option pain dates back to 2004. So, in a sense, this is still a very young theory. As far as I know, there are no academic, scholastic papers on it. which makes one wonder why the academia has ignored this concept. The theory of options pain stems as a corollary to the belief 90% of the options expire worthless. Hence option writers, sellers tend to make money more often, more consistently than the option buyers. Now if this statement is true, then we can make a bunch of logical deductions. At any point only one party can make money, i.e. either the option buyers or option sellers, but not both. From the above statement, it is clear that the sellers are the ones making money. If option sellers tend to make maximum money, then it also means that the price of the option on expiry day should be driven to a point where it would cause least amount of loss to option writers. If point 2 is true, then it further implies that option prices can be manipulated, at least on the day of expiry. If point 3 is true, then it further implies that there exists a group of traders who can manipulate the option prices, at least on the day of expiry. If such a group exists, then it must be the option writers, sellers, since it is believed that they are the ones who make maximum money, consistently make money trading options. Now, considering all the above points, there must exist a single price point at which, if the market expires, then it would cause least amount of pain to the option writers or cause maximum amount of pain to option buyers. If one can identify this price point, then it's most likely that this is the point at which markets will expire. The option pain theory does just this: identify the price at which the market is likely to expire, considering least amount of pain is caused to option writers. Here is how OptionsPain.com formally defines option pain in the options market. Wealth transfer between option buyers and sellers is a zero-sum game. On option expiration days, the underlying stock price often moves toward a point that brings maximum loss to option buyers. This specific price, calculated based on all outstanding options in the markets, is called option pain. Option pain is a proxy for the stock price manipulation target by the option selling group. 13.3 Max Pain Calculation. Here is a step-by-step guide to calculate the max pain value. At this stage, you may find this a bit confusing, but I recommend you read through it all the same. Things will get clearer once we take up an example. Step 1. List down the various strikes on the exchange and note down the open interest of both calls and puts for these strikes. Step 2. For each of the strike price that you have noted, assume that the market expires at that strike. Step 3. Calculate how much money is lost by option writers, both call option and put option writers, assuming the market expires as per the assumption in Step 2. Step 4. Add up the money lost by call and put option writers. Step 5. Identify the strike at which the money lost by option writers is least. This level, at which least amount of money is lost by option writers, is the point at which maximum pain is caused to option buyers. Therefore, this is the price at which the market is most likely to expire. Let us take up a very simple example to understand this. For the sake of this example, I'll assume there are only 3 nifty strikes available in the market. I have made a note of the open interest for both call and put options for the respective strike. Strike call option OI, put option OI. 7700-18234005783025 7800-34485754864125 7900-5367-450-2559375. Scenario 1. Assume markets expires at 7,700. Remember, when you write a call option, you will lose money only if the market moves above the strike. Likewise, when you write a put option, you will lose money only when the market moves below the strike price. Therefore, if the market expires at 7,700, none of the call option writers will lose money, which means call option writers of 7,700, 7,800, and 7,900 strikes will retain the premiums received. However, the put option writers will be in trouble. Let's start with the 7,900 pay writers. At 7,700 expiry, 7,900 pay riders would lose 200 points. Since the OI is 2,559,375, the rupee value of loss would be equals 200 asterisk 2,559,375 equals 5 rupees, 11,875,000. 7,800 pay riders would lose 100 points. The rupee value would be equals 100 asterisk 4,864,125 equals 4,864,125,000 rupees per. 7,700 pay riders will not lose any money. So the combined money lost by option riders if the markets expire at 7,700 would be total money lost by call option riders plus total money lost by put option riders equals 0 plus 511,875,000 rupees plus 864,125,000 equals 9 rupees, 98,287,500. Keep in mind that total money lost by call option riders equals money lost by 7,700 CE rider plus money lost by 7,800 CE plus money lost by 7,900 CE. Likewise, the total money lost by put option riders equals money lost by 7,700 pay rider plus money lost by 7,800 pay plus money lost by 7,900 pay. Scenario 2: assume markets expires at 7,800. At 7,800, the following call option riders would lose money. 7,700 CE riders would lose 100 points. Multiplying with its open interest, we get the rupee value of the loss. 100 asterisk 1,823,400 equals 1 rupee, 82,340,000. Both 7,800 CE and 7,900 CE seller would not lose money. The 7,700 and 7,800 pay seller wouldn't lose money. The 7,900 pay would lose 100 points. Multiplying with the open interest, we get the rupee value of the loss. 100 asterisk 2,559,375 equals 2 rupees, 55,937,500. So the combined loss for options riders when market expires at 7,800 would be equals 182,340,000 plus 255,937,500 equals 4 rupees, 38,277,500. Scenario 3: assume markets expires at 7,900. At 7,900, the following call option riders would lose money. 7,700 CE rider would lose 200 points. The rupee value of this loss would be 200 asterisk 1,823,400 equals 3,646,800,000 rupees per. 7,800 CE rider would lose 100 points. The rupee value of this loss would be 100 asterisk 3,448,575 equals 3 rupees, 44,857,500. 7,900 CE riders would retain the premiums received. Since market expires at 7,900, all the put option riders would retain the premiums received. So therefore the combined loss of option riders would be equals 3,646,800,000 plus 344,857,500 equals ours 7,095,375,000. So at this stage, we have calculated the total rupee value loss for option riders at every possible expiry level. Let me tabulated the same for you. Strike call option OI put option OI loss value of calls loss value of puts total loss 7700-1823400-5783025-0998287500998287500 7800-344-857-54864125125-182340000-255937500-438277500 709-537-450-255-937-5, 709-537-5000, Now that we have identified the combined loss the option writers would experience at various expiry level, we can easily identify the point at which the market is likely to expire. As per the option pain theory, the market will expire at such a point where there is least amount of pain, read it as least amount of loss to option sellers. Clearly, from the table above, this point happens to be 7,800, where the combined loss is around 438,277,500 or about 43.82 crores, which is much lesser compared to the combined loss at 7,700 and 7,900. The calculation is as simple as that. However, I've used only 3 strikes in the example for simplicity. But in reality there are many strikes for a given underlying, especially nifty. Calculations become a bit cumbersome and confusing. Hence one would have to resort to a tool like Excel. I've calculated the option pain value as of today, the 10th of May 2016, on Excel. Have a look at the image. For all the available strikes, we assume market would expire at that point and then compute the rupee value of the loss for CE and K option writers. This value is shown in the last column titled Total Value. Once you calculate the total value, we simply have to identify the point at which the least amount of money is lost by the option writer. You can identify this by plotting the bar graph of the total value. The bar graph would look like this. As you can see, the 7,800 strike is the point at which option writers would lose the least amount of money. So as per the option pain theory, 7,800 is where the market is likely to expire for the May series. Now that you have established the expiry level, how can you use this information? Well, there are multiple ways you can use this information. Most traders use this max pain level to identify the strikes which they can write. In this case, since 7,800 is the expected expiry level, one can choose to write call options above 7,800 or put options below 7,800 and collect all the premiums. 13.4 A few modifications. In the initial days, I was very eager to learn about option pain. Everything about it made absolute sense. I remember crunching numbers, identifying the expiry level, and writing options to glory. But shockingly the market would expire at some other point, leaving me booking a loss and wondering if I was wrong with my calculations or if the entire theory is flawed. So I eventually improvised on the classic option pain theory to suit my risk appetite. Here is what I did. The OI values change every day. This means the option pain could suggest 7,800 as the expiry level on 10th of May and may very well suggest 8,000 on 20th of May. I froze on a particular day of the month to run this computation. I preferred doing this when there were 15 days to expiry. I identified the expiry value as per the regular option pain method. I would add a 5% safety buffer. So at 15 days to expiry, the theory suggests 7,800 as expiry. Then I'd add a 5% safety buffer. This would make the expiry value as 7,800 plus 5% of 7,800 equals 8,190 or 8,200 strike. I would expect the market to expire at any point between 7,800 to 8,200. I would set up strategies keeping this expiry range in mind. My most favorite being to write call options beyond 8,200. I would avoid writing put option for this simple belief: panic spreads faster than greed. This means markets can fall faster than it can go up. I would hold the options sold up to expiry, and would usually avoid averaging during this period. The results were much better when I followed this method. Unfortunately, I never tabulated the results. Hence I cannot quantify my gains. However, if you come from a programming background, you can easily backtest this logic and share the results with the rest of community here. Anyway, at a much later stage one realized the 5% buffer was essentially taking to strikes which were approximately 1.5 to 2% standard deviations away, which meant the probability of markets moving beyond the expected expiry level was about 34%. If you are not sure what this means, I'd suggest you read this chapter on standard deviation and distribution of returns. You can download the option pane computation Excel. 13.5 The put-call ratio. The put-call ratio is a fairly simple ratio to calculate. The ratio helps us identify extreme bullishness or bearishness in the market. PCR is usually considered a contrarian indicator, meaning, if the PCR indicates extreme bearishness, then we expect the market to reverse. Hence the trader turns bullish. Likewise, if PCR indicates extreme bullishness, then traders expect markets to reverse and decline. To calculate PCR, all one needs to do is divide the total open interest of puts by the total open interest of the calls. The resulting value usually varies in and around 1. Have a look at the image below. As on the 10th of May, the total OI of both calls and puts has been calculated. Dividing the put OI by call OI gives us the PCR ratio. 37,016,925 42,874,200 equals 0.863385. The interpretation is as follows. If the PCR value is above 1, say 1.3, then it suggests that there are more puts being bought compared to calls. This suggests that the markets have turned extremely bearish, and therefore sort of oversold. One can look for reversals and expect the markets to go up. Low PCR values such as 0.5 and below indicates that there are more calls being bought compared to puts. This suggests that the markets have turned extremely bullish, and therefore sort of overbought. One can look for reversals and expect the markets to go down. All values between 0.5 and 1 can be attributed to regular trading activity and can be ignored. Needless to say, this is a generic approach to PCR. What would really make sense is to historically plot the daily PCR values for say 1 or 2 years and identify these extreme values. For example, for Nifty, values such as 1.3 can indicate extreme bearishness. But for say NFI, something like 1.2 could be extreme bearishness. So you need to be clear about this. Hence backtesting helps. You may wonder why the PCR is used as a contrarian indicator. Well, the explanation to this is rather tricky. But the general opinion is this: if the traders are bearish-bullish, then most of them have already taken their respective position, hence a high-low PCR, and therefore there aren't many other players who can come in and drive the positions in the desired direction. Hence the position will eventually be squared off, which would drive the stock index in the opposite direction. So that's PCR for you. You may come across many variants of this. Some prefer to take the total traded value instead of OI. Some even prefer to take the volumes. But I personally don't think it is required to overthink PCR. 13.6 Final thoughts. And with this, I'd like to end this module on options, which has spread across 2 modules and 36 chapters. We have discussed close to 15 different option strategies in this module, which I personally think is more than sufficient for retail traders to trade options professionally. Yes, going forward you will encounter many fancy option strategies. Perhaps your friend will suggest a fancy option strategy and show off the technicalities of the strategy. But do remember, fancy does not really translate to profit. Some of the best strategies are simple, elegant, and easy to implement. The content we have presented in both Module 5 and Module 6 is written with an intention of giving you a clear picture on options trading, what is possible to be achieved with options trading and what is not possible. We have thought through and discussed what is required and what isn't. Frankly, these 2 modules are more than sufficient to answer most of your concerns, doubts related to options. So please do take some time to read through the contents here at your own pace. And I'm certain you will start trading options the way it is supposed to be done. Finally, I hope you will enjoy reading this as much as I enjoyed writing this for you. Good luck and stay profitable. Key takeaways from this chapter. Option pain theory assumes that the option writers tend to make more money consistently compared to option buyers. Option pain assumes that option writers can influence the price of options on the day of expiry. One can use the theory of option pain to identify the price at which the stock index is likely to expiry. The strike at which the option writers would experience least amount of loss is the strike at which the stock index likely to expire. The PCR is calculated by dividing the total open interest of puts by the total open interest of the calls. The PCR is considered as a contrarian indicator. Generally, a PCR value of over 1.3 is considered bearish and a PCR value of less than 0.5 is